Hi, I'm Colin Prasad from Moore Stephens Corporate Advisory Melbourne office. Today I'm talking about how we go about business valuations and in particular how your instructions matter. In giving us instructions to undertake a valuation, we need to understand the what, the why, the when and the how. Your instructions matter because answers to these questions can change the value we may come up with. The what is giving us an understanding of the business as well as what we are valuing. Is it enterprise value, 100% equity value, or a minority interest? The why is what is the purpose or framework for the valuation. Whilst all valuations are forward-looking, the when is really important. If you were to ask us to do a value of a business as of 31 December 2007, we should only take into account information reasonably known at that time. The how includes the standard of value, the evaluation method and the type of report. Fair market value is the most common standard, but there are other standards. Usually we decide the valuation method, but sometimes an owner's agreement will define the valuation method. There are three main types of valuation methods, being market, income and asset-based methods. Market determines value by looking at comparable companies or transactions. For private companies that can be hard to find exact comparables, but we can usually find some data on similar public companies that at least informs some of the other methods. The income methods are a multiple of future maintainable earnings or a DCF-based approach. In some respects they are similar approaches, with the emphasis on future, normalised, maintainable earnings. But a DCF approach can provide greater precision by allowing for lumpiness in cash flows, tax and capex payments. Asset-based approaches are usually used for asset-rich entities or where there is unlikely to be any goodwill. So how does a valuation come together? Let's say we use our income valuation methods applied as a multiple of earnings or a discounted cash flow. The number we come up with is called the enterprise value. This is the total value of the business assets and is made up of working capital, tangible and intangible assets, including goodwill. Usually, however, we are asked to come up with an equity value. We can derive this from the enterprise value by adding surplus assets and deducting debt. Surplus assets are usually cash or any asset that is not required to generate the earnings or cash flows. The way to think about it is enterprise value is what you can sell your house for, equity value is what you get after you pay back the bank. It is important to note that the equity value is 100% control value. If we are valuing a minority interest, we usually apply a discount for lack of control. We may also apply a marketability discount. These discounts to equity value can be significant. Business valuations are an opinion. We strive for a defendable and robust process in determining our opinion. Some issues with valuations we see are poor quality information, rules of thumb, instead of using verifiable, comparable transaction data. Unsupported other assumptions such as for discount rates, multiples or normalisations. We also try to have a view as to where the business we are valuing is likely to sit on the risk-return yield curve as a valuation cross-check. Confusion of personal goodwill versus business goodwill. Personal goodwill is much harder to transfer. Reports not prepared in accordance with APES 225, our professional standard. A good valuation should be less wizardry and more sober, like this fellow here. To get started, we need your instructions. That's the what, including a business overview, the why, the when, and the how. We also need financials, with the emphasis on forecasts, as all valuations are forward-looking. It's useful for us to know about any normalisations, for example, non-commercial transactions with owners, as well as having a copy of any owners' agreements. There are 3 types of valuation engagements we can do under our professional standard APES 225. A calculation engagement is generally a short-form report where you instruct us on the approach and methodology, for example, to calculate value in accordance with an owner's agreement formula. A limited scope engagement is a mid-length report where we determine most of the approach and methodology, but there is some restriction or limitation on our work, for example, a lack of forecasts. A full scope engagement is a full report with no restrictions in our approach or methodology. So that's how we approach business valuations, and as I said, your instructions really matter. I hope you have found this presentation useful. I'm Colin Prasad. Thanks for watching.